Friends, I extend a very warm welcome to our 156th webinar on simplified regulation for debt securities, game changer for securities market. As you are aware that we are normally organizing program more on the equity side, but this is one topic which is taking traction now, and this is our 156th webinar. So those who are coming first time, I just want to inform them, since last 3 years, when the COVID started in 2020, April, we started a first webinar. And since then, every Friday, 4 to 6, we are continuously organizing webinar on topical interest. So this is our 156th webinar. So this continuity and the support from everybody is remarkable. And the participants are also joining in every program. Today's topic is very, very interesting, but for it, the audience is very limited because the debt market is not for everyone, and this is slowly taking shape. So in the budget announcement in 2023-24, you remember our finance minister, she said to simplify, ease and reduce cost of compliance, financial sector regulator will be requested to carry out a comprehensive review of existing regulation. For this, they will consider suggestions from public and regulated entities. So the corporate bond is a one market which is coming into this category, and the government is interested that Indian regulator as well as the corporate world should adopt this instrument, because equity always, no doubt, our interest, our saving rate is highest in the world, 32%, but it is going majority in the part of non-moving asset like property and other thing. So they want it should go to equity. Simultaneously, they want that it should go in the debt market also. But debt market is identified as a market of few people, bank, institution, and big players, not of the public. And this particular mode of corporate bond, if it is started for the public, it will be very good. And the money which is lying in those people which are not interested in risk, they can benefit it and they can join this. You just see, if you compare with the market of the FD market and the money lying in the debt market, it is no doubt its money is using through the bank, but in bond market that money is coming, it is directly using for the capital buildup and the asset buildup in the country. So the corporate bond market constitutes a vital segment within the global capital market. Serving is a important role to finance the real economy and offering an alternative to traditional banking channel, which I just told you, in place of FD, people can invest. There is a growing trend amongst corporate to seek debt financing by NCD, and advantageous aspects of these instruments in that even unlisted company can list their NCD. The SEBI issue and listing of non-convertible security regulation 2021, that is called NSCS regulation, provide the framework for issuance of listing of debt securities. With a view to promoting ease of doing business, SEBI released a consultative paper on review of provision of NCS regulation and LODR regulation for ease of doing business and the introduction of fast-track public issue of debt securities. The deadline for submitting these comments, suggestions to SEBI is December 29 of this particular next week. The objective of webinar is a twofold. First, we want to discuss the debt market, the listed debt market, how this is a game changer in securities market, and the brief of NSC regulation, LODR regulation for debt, and new green bond framework of SEBI. That is just general concept so people can understand. And then we will discuss about the consultative paper, where they have suggested various issues. Like the consultative paper has asked reduction in denomination and appointment of merchant banker, QR code in offer document, detail of certain information offer document, standardization of shut period, harmonization of due diligence certificate. These are the basic point which has come, and then publishing financial result in newspaper, newspaper, and the fast track public issuance and listing of debt securities. So if you see this, whatever efforts SEBI has done for the development of equity market, the government is trying, and I think Pradeep is doing a phenomenal job in this. And this particular work of listing of debt security, and then public joining as a and treating as a instrument, and they can buy and sell like shares. It is the object of this particular concept, which we will discuss today. So I extend a very hearty welcome to our guest speaker. First, I will welcome Mr. Pradeep Ramakrishnan. He's a general manager, SEBI. He has been more than 25 years of experience, which includes 5 years in private sector and 20 plus years as a regulator. He has specialized in regulatory framework on ESG, corporate governance, listing related issue, fixed income market. I welcome Pradeep for this program. And we will definitely benefit by your extensive knowledge on this subject, and the way you are pushing this market regulation and the changes. It's remarkable. Then we have Nikhil Chaudhary, is a manager department of debt and hybrid securities, SEBI. I welcome Nikhil for this program. Then we have Priyanka Meena. She's assistant manager department of debt and hybrid security, SEBI. So both Nikhil and Priyanka, we will definitely take advantage of your knowledge and your work and what is happening and how you are seeing the market for future. That is important. So other people should encourage and come. And then we have Miss Meeta Kurpat, that she's a partner, Shriral Amarchand Mangalas. Meeta has over 11 years of experience in the banking and financial sector and specializes in structured financing, project finance, receivables, asset-backed finance, cross-border financing, stressed debt transaction, and asset resolution. So more and more, all things related to the specialized other market other than equity. So Meeta will definitely help. And Meeta, she was the member of this committee also. So she can give certain interesting aspects on this. Then I have Ankit Singhi. He's a head corporate affairs and compliance corporate professional. So friends, these are our learned panelists. And the today's topic, which I told you, is a really a game changer. Why I told and I requested Pradeep that if you can highlight that how this debt market, if it is coming and it is coming with the ease, then how the public can participate and how the public money which is coming, which is lying idle in the banking sector, can be useful. And in India, if you see that we have a 8 or 9 crore demat account. So these are the interested investors. But the number of people are more, the FD amount, the bank account is more, and their money which is lying there, it is because, not because of this, because of two reasons. One is they don't want to take risk, they want fixed income, and they want to play safe. So if debt market, this bond market can provide, the debt security can provide that same type of security and ease of doing, because I'm going to have bank putting money in, they are doing FD. So here you have to have something more to do. More education is required, more knowledge is required, more encouragement from the regulator as well as public side is required. Then this market can bloom. So I hope that Pradeep can give the new dimension and tell us that how this market can change the, can be a game changer for security market. So friends, without taking much time, I will request Pradeep Ramakrishnan, who is today's our chief guest for this program. Over to you, Pradeep.
Thanks, Sponsor. Thank you. I would like to congratulate corporate professionals for an uninterrupted series of webinars almost every Friday, and on a varied range of topics, which is very useful to professionals and even from the government servants and whatnot. So it actually helps a lot of us to know about different facets. And one such facet which is very rarely talked about is the bond market as far as India is concerned. because bond
Pradeep, can you
market,
switch off your video?
only people who are in the bond markets know about the bond market, right? So it's like the other side of the moon, as I always like to say. But you will be very surprised to know that out of 10 lakh crores that was released last year.
Pradeep,
Okay,
can you
fine,
switch off
fine.
your video? I think there's.
So you will be surprised to know that out of 10 lakh crores that was raised last year, 2 lakh crores was raised from the equity market, which can actually tell you the significance of the bond markets as far as India is concerned. Yeah. So I will not be doing the presentation today. But yeah, so as I was saying, the bond markets to that extent are very significant as far as India is concerned. One of the importance of the bond markets can be gauged from the fact that generally when you need money, the banks are the source and the financial institutions are the source to which one turns to. The bond markets offer a huge relief for banks, and recently RBI has also been batting for reducing the burden on banks. So where is the source to which the corporate turns to? So the bond market is the answer to that, and SEBI has made things very easy for companies to borrow from the bond market by making it even companies without track record to borrow. A couple of years back, you needed a 3-year track record to borrow from the capital market, from the bond markets. Now you don't need any track record also to borrow from the bond market. The last 1.5, 2 years in particular we have seen a lot of reforms. I mean, the reforms have been happening for the past 3-4 years, but the last 2 years we have sort of concentrated completely on a lot of things as far as the bond markets are concerned, right from large corporate reforms to online bond platforms, and we brought in things on once listed, always listed, so many things on corporate governance for high value debt listed entities. So essentially, if you see, any NCD that has a validity period of 1 year and above will come under SEBI. If it is issued for up to 1 year, it comes under the purview of RBI. So what Nikhil and Priyanka will be talking to you about will be for those NCDs which have a maturity period of more than a year, and they will be taking you through the new NCS regulations. I still call it new because it's still only 2 years since it has been issued. And they will also be talking about green bonds. They'll be talking about municipal bonds, and they will also be giving you an insight as to what is the new paper like. Okay, and thankfully we have one of our members also there, Miss Meeta, who represents FICCI on the committee. So she'll also be giving her expertise on what about this thing. And I would like to tell you that the thing about ease of doing business is something SEBI attempted first in 2020, and we have tried to do that consistently. And over the past 1.5 years, if you see, while there have been many efforts on ease of doing business, we may not separately have labeled them as ease of doing business. But if you look at the reforms, there are many of things which have made things easier, bunching of multiple, filings and whatnot. So this time, however, it is a specific thing. As in October, we had come out with a paper, and we are just extending. The present paper is more of an extension of those suggestions that were taken from the public. So that also will be discussed today. And we are also bringing out a new concept of fast track public issue. So if you see, ever since the online bond platform reforms came into play, the retail participation in the bond market has actually shot up from 1% to 4% in the secondary market, which is a very, very heartening thing for everyone. This I'm saying because people traditionally used to look at real estate and gold as sources of investment. Now this means that they are looking at the bond markets also as a source of investment, which is a heartening thing for us. So without much ado, I would hand over the baton to Nikhil and Priyanka to take you through the next hour or so with their presentations, and then probably we can take along from that on.
Pradeep,
Thank you.
Thank you very much. I just want to ask one question as a economic point of view. Now, the banking system is running on the basis of deposits and lending. That is their main income and main source of income and business. So suppose we are converting the RBI saying there is a stress on bank or pressure on bank. So do you think that there is some study where they have identified that banking sector is, if bond market is going up and becoming very popular, then do you think banking sector will not be disturbed?
Sir, banking can never be substituted. Okay, so we would like to really clarify this. for any sector, any financial sector, for any manufacturing sector, the primary lifeline of business will always be banking. Okay. So, but what is important is that it's not burdened with every line of credit, right? So everyone should not be going to the banks and financial institutions for every line of credit. There is a huge source outside, and there are people with deep pockets. You have private equity investors, you have large financial institutions, and you have even other type of investors. We even have individual investors who have money. So this is the crowd which is also wanting to give money. So essentially, if you look at the world also, capital is not the problem. You have to tap the right source. So while we will certainly not be able to substitute any bank or financial institution, here the aim of the bond market is to supplement and lessen the burden on the banks and the financial institutions. So that's perhaps the answer that I would like to give. And before Priyanka and Nikhil start, there is one disclaimer which we would like to say. The comments which we are expressing on this program are personal, and they have got nothing to do with SEBI. They are not SEBI's comments. They are our personal comments.
Yeah.
I hand over to Nikhil and Priyanka.
Nikhil and Priyanka, now over to you for your presentations.
Thank you, sir. We'll share our screen and then we'll take you through the presentation. Sir, I hope the presentation is visible.
Yes, it is visible. Just go to the slideshow.
It's on the slideshow mode only, sir.
Yeah, this is the top. From the beginning, you can start.
Okay, so
is it visible from the beginning?
So I think you need to shift it to the slide mode. You can click the from beginning button on the top of your screen. That's on the left hand side. Yeah, from beginning, yes. It's not working.
So it has come. First page has come. Just go to the.
Can you put it on slideshow?
Yeah. Yes.
Must be on the bottom right.
Yeah, trying that.
Yeah, this one. Yeah, click this.
Has it happened? Yeah, we have clicked it actually. Is it coming now?
No, not yet.
Just a second.
Yeah.
Can you press F5 after putting the presentation on screen?
Is it coming now?
Yes,
Yes,
perfect.
Perfect.
Okay.
So hello everyone. So we have structured our presentation in 3 parts. First, I will take you through the SEBI issue and listing of non-convertible securities regulation. And then Nikhil will take you through LODR regulations. Then both of us will take you through the SEBI's green bond framework. So before I go on to the NCS regulations, I just want to show the.
Hi, can you share a meeting ID? Someone wants it. So, or can you share, or can you share the link or anything? Yeah, because I want to give it to someone else. My CGM already wants to see. That is right.
Yeah, go on.
Okay, so today corporate bond market stands at almost 45 crores, and out of those 45 crores, 81% of the 45 lakh crores, so 81% of the total outstanding is listed issuances, listed NCDs. So on the right hand side, if you see, 73% of the total amount raised is AAA rated. So basically, Indian debt market is heavily concentrated in AAA rated debt securities. So now if an issuer wants to enter into debt market, so they have to follow through NCS regulations, issuer can tap the debt market through public issue or through private placement route. So if an issuer is coming through private placement route and issue size is 50 crore or more, then the issuer has to mandatorily come through the EBP platform. So participants involved. So in case of private placement and public issue, the major difference is appointment of merchant banker. In case of public issues, issuer need to appoint merchant banker, but that requirement is not there in case of private issues. Every issue has to be rated by at least one credit rating agencies. So, for example, if an issuer choose to get rated by one or more than one credit rating agencies, then all the credit rating agencies has to be disclosed in the offer documents. Similarly, every issuer has to appoint a debenture trustee. They have to get an in-principle approval from stock exchanges. And currently, all the issuances has to be happened in demat form only, and that's where depositories come into picture. Issuers need to get into agreement for dematerialization of the securities with depositories. Moving on. So NCS regulations prescribe eligibility criteria for the issuers. So for example, it says that issuer should not be debarred, issuer or its promoter should not be debarred from accessing the securities market. And the promoters or directors should not be a promoter or director of the company which is debarred from accessing the securities market. And in case of public issues, issuer should not be a willful defaulter. Issuer's promoter or whole-time director should not be a willful defaulter, should not be a fugitive economic defender, and there should not be any penalties levied by SEBI or stock exchanges that are pending. So if an issuer is coming with frequent issuances, SEBI has provided a path that they can file a shelf prospectus so that the issuer can do away with the filing of heavy documents every time they come up with the issue. So issuers can file a shelf prospectus, and when they are coming with the issue, they can just file a tranche prospectus, which need not be as heavy, just the updated information and the material information needs to be there in the tranche prospectus. Now I'll take you through some of the concepts in NCS regulation. In principle, approval from stock exchanges. So any issuer coming with the issue of their debt securities and they intend to list on stock exchange, they have to file an application with the stock exchanges to get an in principle approval. Draft offer document. So issuers coming up with public issue, they need to file the draft offer document with the stock exchanges, and stock exchanges then keep it open for public comments for 7 working days. Once that period is over, issuer incorporate all the comments they might have received on the offer document, and then they file the final offer document. The draft offer document shall contain annual reports of previous 3 financial years. They should make the disclosures as prescribed in Schedule 1 of NCS regulations. Advertisement. In case of public issues, issuer needs to mandatorily make advertisement of the issue in English National Daily and 1 regional daily. But this requirement, private placement of the issue cannot be advertised. And minimum subscription requirement. So NCS regulations prescribe that for public issues, issue needs to be subscribed at least 75% of the base size. So for example, if a issuer is coming up with 100 crores of issue and issuer has got only 50 crores of subscription, then the issue can't go through. Issuer will need to refund its money. And then if you are coming through a public issue route, you have to mandatorily list your securities. There cannot be any public issue of debt securities that will be unlisted. So one of the distinguished or unique characteristics of debt securities is that an issuer can get listed through private placement route also. Unlike equity, in equity, if you want to get listed, you have to come through public issue only. But in debt, you can come through private placement and then get your securities listed. So underwriting. In case of public issue, eligible intermediaries can underwrite the issue in part or the full in case of public issues. And for private placements, we have recently introduced a anchor portion, where some of the portion is reserved for the arrangers or merchant bankers involved in the issue. So due diligence. In case of public issues, so if you see, there are a lot of this focus on due diligence, appointment of merchant banker in case of public issue. That is because in case of public issue, retail participants are involved, and they may be not mature as the investors in the private placement market. So that's why SEBI has, to protect the interest of the investors, SEBI has prescribed little stricter norms for public issues with this. So yeah, so in due diligence, in case of public issues, merchant bankers, debenture trustees, they have to furnish due diligence certificate, security cover. So issuance of securities can be secured and unsecured. So if an issuer is coming with the secured issuance, they need to have a security cover. They need to create a security, and the value of that security cannot be less than 100% of the issue size. So basically, at all times, issuer has to maintain a security cover of 100% or more. So now the concept of oversubscription. So let's say if an issuer is coming up with the issue size of 1,000 crores and their issue got subscribed, let's say they got a subscription of 3,000 crores. So what happens in public issue? Issuer is eligible to retain till 100% of the base size of the issue. But in case of private placement, it can retain up to 5 times of the base size of issue. Consolidation and reissuance of ISINs. So right now, there is a lot of fragmentation, a lot of ISINs in the debt market because of last year we have tried to reduce the fragmentation. We have capped the number of ISINs. So consolidation means basically, for example, if an issuer is raising funds in Q1 and they are raising fund in Q2, but the characteristics of the funds raised in Q2 is similar to what they did in Q1. For example, the date of maturity, coupon payment frequency, then they can consolidate overall issuance in one ISIN. So that is consolidation. And reissuance is you can reissue the existing ISIN once it has matured. Moving on. Yeah. So like Pradeep sir was mentioning that we have allowed, so currently, earlier what used to happen, an issuer has to have a track record of 3 years to tap in, to come to the capital debt market. But right now, to provide access to new issuers who doesn't have a track record, so we have allowed, but with certain caveats. So if an issuer who doesn't have a track record, they need to come through the private placement route only, and they can they have, irrespective of the size, they have to come through the EBP platform of exchange. Right now, if in a traditional format, if someone is coming with a issue size of, let's say, 30 crores, but he has track record of 33 years, then they need not come through EBP platform. But in case of new entities or entities with no track record, they have to come through EBP only, and they have to offer it to only qualified institutional buyers. Now I'll give it to Nikhil. He will take you through the listing and disclosure listing obligation and disclosure requirement regulations. Over to you, Nikhil.
Yeah. Thank you, Priyanka. So just adding on to what Priyanka was mentioning about NCS regulation. So you would have understood by now that there are two routes which are basically happening in issuance of debt securities. One is the private route and one private placement route, and one is the public issuance. So technically, private placement does not mean that it is a totally private thing which is not accessible to a retail issuer. What happens is there is an EBP platform, which is the electronic book provider platform, On that, the issuer has got, on that there are around 800 QIBs, which are qualified institutional buyers, who are already registered on that EBP platform. While those QIBs automatically get any notification about a new issuance which is coming through a private placement route, there are additional investors, retail investors, or any other type of HNIs, other investors, which can also be registered on that platform and mapped by the particular issuer for their private placement issue. So while retail investors do have the probability of accessing private placement issues, but technically it is a given understanding that a private placement route is meant for the QIB and larger investors. So yeah, so while this parallel tracks are existent in the issuance phase, in listing, if you see, there is no differentiation between this private placement and the public issuance. Once an security gets listed, it is a freely marketable security. It gets traded. It is freely tradable between. It can change hands from one investor to the other investor freely. So that's where we do not have any we do not distinguish between a private placement security and a public issued securities in case of continuous disclosures. And where these continuous disclosures are coming from, these continuous disclosures are coming from this LODR regulations, which is the SEBI LODR regulations 2015. So basically, LODR regulations are divided into 11 chapters. Actually, it has more than 11 chapters, which are 11. There is 11A also. So if you see, chapter 1 is basically which prescribes the definitions and applicability of this chapter. And basically, this regulation has disclosure norms for entities with listed specified securities, listed NCDs, listed non-convertible securities, which includes NCDs and NCRPS and a few other securities. It also has chapter which specifies disclosure norms for IDRs, which is Indian Depository Receipts, which specifies for SDI, security receipt mutual fund units. But for the scope of today's discussion, it will be limited to only disclosure norms pertaining to NCDs. So yeah, so like I was mentioning, chapter 1 is on generic definitions and applicability. Chapter 2 is where the principles governing disclosures comes from. So basically, SEBI has been saying it is a principle-based regime, rather comparatively more of a principle disclosure-based regime rather than a rule-based regime. So that's where these principles governing disclosure come, wherein rights of shareholders, role of stakeholders in corporate governance, and the roles of board of directors. Basically, the principles around them have been defined in this chapter 2. Chapter 3 is where these common obligations of listed entities have been specified, which talks about compliance officer appointment and grievance redress mechanism. What should be the what all mechanism should be there as part of this grievance redress mechanism. That's where Scores, which is a unique SEBI platform, comes in. Then also it also talks about the timely payment of interest and dividend to the stakeholders. Chapter 4 is where the obligations of entity with listed specified securities and NCDs or NCRPS has been specified. Only NCDs has been specified. So this chapter is partially applicable in case of entities with listed NCDs. Basically, this chapter also specifies a specific form of entities called high value debt listed entities, which is, as per the current definition, they are defined as entities with outstanding borrowings of more than 500 crores. Why this specific, distinguishing these entities and not making it applicable for all kinds of debt listed entities is because see, any form of corporate governance. So we used to be a equity dominant market earlier, which still we continue to be. But slowly, it is seen that the debt market is expanding. The scope of the debt listed entities is expanding. The number of entities which have their debt listed is expanding. So it was thought fit to extend the corporate governance norms which were applicable on equity listed companies, at least some portion of it to be made applicable in case of debt listed entities. So it was thought that we will start with a certain threshold, which was made 500 crores. And these corporate, if you be aware, right now it is still continues to be on a comply and explain basis, which was extended by 1 more year in 2022 March. But soon it will become mandatory, and the revised corporate governance norms are being framed because of certain difficulties that the entities were facing. So regulation 16 to 27 talk about the applicable norms on high value debt listed entities. Similarly, chapter 5 is where obligations of entities with listed NCS has been specified, NCS, which is basically non-convertible securities. So yeah, like I was mentioning, regulation 16 to 27, which talks about the corporate governance norm for these HVDLEs. While 16 and 17, regulation 16 and 17 are basically just definitions, and which puts the responsibility on the board of directors in respect of these corporate governance norms. Regulation 18 talks about maximum number of directorships that any director can have, which currently it is limited to 7. Further regulation 9, then further regulations talk about the formation of an audit committee. What should be the minimum quorum of having this audit committee? There should be minimum 3 directors that should be part of this audit committee. 2 out of these 3 directors should be independent. Then further it talks about nomination and remuneration committee should be there in any listed entity with high value debt. And again, it also has similar criteria that there should be minimum 3 directors, all should be non-executive, and 2/3 of this committee should be independent. It also talks about formation of stakeholders relation committee, whose role is to look into the stakeholders that are there, basically the equity shareholders, the debt holders, and the other ways that anyone else, your vendors and other things that any entity has as part of their stakeholders. Further, it also talks about appointment of risk management committee. It talks about having a whistleblower policy. And then regulation 23 specifies about related party transactions, what should be the materiality policy and the approval of audit committee for any related party transaction. Yeah. Yeah, so then comes the chapter 5, which talks about the disclosure norms pertaining to listed non-convertible securities. So while regulation 49 talks about the applicability, regulation 50 specifies about intimation to the stock exchanges, which is basically about any key issue, any financial results, any matter that impacts the right or interest of the debt holders, and is to be taken in any board meeting, that needs to be intimated to the stock exchange prior to the meeting itself. Then regulation 51 talks about disclosure of financial results. So disclosure, regulation 51 talks about any immediate disclosure of any news that may have bearing on the price, which has price sensitive information and bearing on the any terms and conditions of the debt of the issuance on the debt holders. Yeah. Then regulation 52 talks about financial results. It's a vast regulation which mentions about what all should be disclosed along with the financial results. The ratio should be there. Then there should be these financial results should be, as and when it is approved, it should be published within 2 days. And disclosure of on quarterly basis unaudited results, and the timelines that should be there. So for every quarter, you have to submit within the 45 days of the end of the quarter, except the last quarter, which gives you 60 days time, because along with the quarterly, you are preparing the annual results also during that time. Then regulation 53 talks about annual report, what should be there as part of the annual report. 54 talks about the security cover. So basically, like Priyanka was mentioning about the secured issuances, our regulations specify that at least 100% of the, if any secured issuances has to be there, then the security behind it should cover at least 100% of it. While the issuer can specify that I'll provide 1.1 cover, 1.2 cover, it should be more than 100%. And the security cover basically should certify that whatever security cover I was mentioning, either 1.1 or 1.2, that is present. Yeah, we can move on next. Yeah, 55 talks about crediting, that at least once in a year, the entity should get its credit rating review, and again, the disclosure of it. Then 56 is an important regulation. It talks about the documents and the intimation that should be given to the debenture trustee. Now, the debenture trustee is a very important intermediary from the perspective of the debenture holders, because it acts in the fiduciary capacity. It is the single sole point from the angle of investors, whose role starts right from the point of the issuance to the and it goes on till the end, till the time the issuer receives each and every penny of his own. While the debenture trustee gets appointed at the time of the beginning, so it does the due diligence at the initial stages, that terms and issuances are there in the favor of the are in the interest of the debenture holders. There is nothing that is basically it is affecting the interest of the debenture holder in the hindsight. Something which is the security that you are providing, it is free of encumbrances, or if there is any encumbrances, there are NOCs that has been taken. So basically, that is the role of debenture trustee that happens at the initial stage, and then the role of debenture trustee continues on a continuous basis, wherein the debenture trustee keeps checking for the security cover on a quarterly basis. Then it also his role also becomes important during the time of the interest payment frequency. So he or she ensures that the payment is being made to the debenture holders as and when it was promised by the issuer companies. And further, another important role comes of the debenture trustee comes to the fore is when a particular issuer defaults or there is any breach of covenants, and and it involves enforcement of security, either enforcement of security or in terms of getting the money back from the issuer. So the debenture trustee carries out the legal steps that are involved for getting the money back. So yeah, so from that angle, these regulation 56 has been carved out so that regular documentation and intimations are being sent to the debenture trustee, based on which debenture trustee can satisfy itself that the terms and conditions of the issuances, the covenants, all are proper, all are there in the place. Yeah, then regulation 57 is again, it is the important regulation from the angle of the investors, which talks about the updation of payment of interest or dividend or principal within 1 working day of it being due. Yeah. Then regulation 58 talks about again documents that should be sent directly to the NCD holders, and what all relevant documents are there. 59 talks about any change in the structure. So basically, what do you mean by a terms or a structure of a non-convertible debt securities? Now, everything cannot be considered as a structure. So basically, there are basic few terms, for example, face value. Then there is the nature of the security, either it is secured or unsecured. These basic date of maturity. So these basic structure should not be, if there is any change that is going to happen in the structure of the NCD or NCRPS, then there should be prior approval that should be taken from the debenture holders, and then there is a prior approval that should also be taken from the stock exchange. So this regulation 59 provides for that. Regulation 59A talks about schemes of arrangement, the various steps involved, who should submit what and at what time. Regulation 59A is about that. Regulation 60 mentions about a record date. Yeah, we can move on. 61 talks about again, it talks about ensuring timely payment on behalf of it puts the onus on the issuer. 61A is a newly inserted regulation which talks about unclaimed the money that is still remaining unclaimed in case of any past issuance. So what should and if it remains unclaimed after a period of 7 years, then it basically goes to the IPEF, and it specifies on the procedure how someone can get the money back from the IPEF. And regulation 62 talks about minimum disclosure requirements on the website of the issuer. Regulation 62A is one of the regulation which was recently inserted 6 months ago, and it specifies about listing of subsequent issuances of NCDs by any issuer. Just to give a bit of background on this regulation, why this was inserted. So SEBI has been on a path of developmental, wherein developmental measures have been taken. But SEBI's another, key key area of work is to ensure that debenture holders or the investors are not done any wrong or any injustice. So SEBI observed that lot of entities which are coming out with listed debt are
तेरा number है कहना है
yeah. So SEBI also observed that lot of entities that are coming out with listed debt are also subsequently issuing unlisted debt. Now these unlisted debt may contain certain terms and conditions which are favorably done and are not being brought in the public disclosure. So in order to provide fair disclosures to everyone, this regulation was brought in place, which specifies that pursuant to starting from January 1, 2024, any entity that comes out, that is as on 31st December, any entity that has listed debt can only issue subsequent listed debt. It cannot come out with any unlisted debt. Further, if any entity, barring there are exemptions, so certain there are 3 types of issuances that have been provided exemptions, given there are multilateral institutions involved that may like to invest in certain bonds of the issuers. So in case they are there and these instruments are in the nature of hold to maturity and are locked in, so then we don't have any issues with that. Those can be there. But we have also specified that the key terms and conditions of these 3 exempt categories that are there, those shall be disclosed on the stock exchanges. Yeah. So yeah, moving on to the next topic, which is basically the green bond framework that is there. So just to give a brief background, basically this sustainable finance contains 3 pillars, that is their ESG, then there is sustainable and responsible investing, and then there is corporate social responsibility. Now this yeah. So I think we can skip this, but basically just to sum this slide up, while we used to keep looking at return as the only measure of any form of the plain numbers as the any form of return that we used to get out of any investment. But now this responsible investing has become the key, the word of the mouth, wherein now the investor not only looks at what return he is getting out of it, but also where his money is being invested in. So, and also from the issuer's perspective, earlier it used to be shareholder theory, wherein the issuer used to only care about its shareholders, but now it has changed to stakeholders theory, wherein you also look at everyone who you are impacting out of your activities. So either be it environment or be it a random person on the road. Yeah. So keeping those things in mind, and even everywhere around the world, if you see these sustainable development goals have been established by the UN. So, and as part of these SDGs, even regulators came to the fore, and we introduced the concept of green debt framework as part of our regulations. And green debt has been part of this NCS regulation since 2016. And to basically summarize, there are 4 types of thematic bonds overall. In India, you will only see green bonds right now in the Indian listed perspective. But the thematic bonds also contain green bonds. There are social bonds, if you see globally. Then there are sustainability bonds, and then there are sustainability linked bonds. So yeah, and if you see overall the issuances of these GBSSB, which are green bonds, social sustainability and sustainability linked bonds, if you see the issuances across the globe have been increasing. And yeah, and so basically this is the people are looking more and more to invest in this category in order to be a responsible investors. Now, if you see the issuance of green bonds from the perspective of Indian context, we only have green bonds right now. And if you see the issuance of green bonds by countries, India stands at pretty low compared to some of the countries. China, who is who has been the highest issuer of green bonds and has issued $85.4 US billion in 2022 alone. In comparison to that, we stand somewhere, we are just a 3% of that figure. And if you see, basically on the Indian listed under the NCS regulation, these are the 16 issuances that are being there. While there are more than 16 ISINs. So if you see, Indore Municipal Corporation and Ghaziabad have issued in multiple securities. They have 4 or 5 ISINs across this. But these are the 16 issuances, and there are 15 unique issuers in that. And this is there since 2016. So just 16 issuances in 6 years, and which is amounting to 4,783 crores. Yeah, we can go ahead. So SEBI had introduced, like I was mentioning, this green debt securities definition was there in 2017 in the NCS. But with the changing landscape and the buzz around the sustainable finance, it was thought well fit to revamp or review the definition that was there in our regulations. So we carried out a consultation. We issued a consultation paper in August 2022, and we basically what the consultation proposed was, it proposed alignment of the green bond definition with the ICMA's green bond principles. These green bond principles have also been recognized by ISCO, and SEBI being a ISCO member, it was thought well that we should also align our definition with the ICMA's definition. And on that principle, we published a consultation paper. This consultation paper basically looked to enhance the definition of green debt securities by involving 3 things in that, 3 new things, while we also involved circular economy adapted products in that. But other than that, there were 3 major things which introduced the concept of blue bonds, yellow bonds, and transition bonds. Now, you would ask, these colors are now these blue bonds, yellow bonds, transition bonds could have been defined separately. But at times things get lost in translation, or things get lost in nomenclature. So in order to not divert the funds and have a dedicated issuance in the beginning, and if thought fit, in some time in future, we may define it separately. So it was thought good that at this point of time we may define them as part of as subcategories of green itself. So basically we introduced the concept of blue bond, which is related to water management and marine sector, sustainable activities related to water management and marine sector. Yellow bonds are sustainable activities related to solar energy. And then this transition bond is a specific bond. So you won't find this transition bond, generally you won't find them as part of the green debt anywhere in the world. Now this transition bond was defined specifically keeping India's nationally determined contributions as part of COP21 and COP26 in mind. Basically, India wants to go towards net zero economy by 2050. So keeping those things in mind, this definition was brought in, and it was thought well that we will have transition bonds also as part of the definition of green debt securities. Someone who is looking to transition towards a cleaner economy. And however, we do have a lot of global investors that are looking to invest in green bonds in India. So keeping their interest also in mind, who only want to invest in pure green debt, we thought transition bonds, we will define a bit. Transition bonds, we'll have certain requirements different for transition bonds. So we came out with a circular in May 2023, wherein we said that there will be a denotation of GBT to differentiate transition bonds from other categories of green bonds. And then there will be disclosure of transition plan with the interim targets. And as and when there is any change in those targets, or there is any deviation from that target, there will be disclosure on the stock exchange. And yeah, so basically we prescribe these disclosure requirements for those transition bonds. Yeah. Now coming to greenwashing, Priyanka will take you through greenwashing.
Thank you, Nikhil. So greenwashing, basically, there is no universal definition of greenwashing. What is green for me may not be green for someone else. So in our context, what we mean by greenwashing is basically you are raising funds saying that my project is green as per our definition in NCS regulations, but you are not utilizing it for green. You are just portraying it as green, but in reality, it is not green. So that is greenwashing. So while SEBI enhanced the scope of definition of green debt securities, SEBI also released guidelines for issuers so that they avoid and reduce the instances of greenwashing. So how can we reduce the instances of greenwashing? So we have issued the guidelines to issuers, and it is also required that issuers become aware. So investors become aware. They should also know that what is green and what is not. So investor awareness is the key to avoid greenwashing, because if investors are not aware, they'll not be knowing what is happening with their funds and where is it going, if it is really going to the green projects or not. So couple of examples of greenwashing. Recently, BP, British Petroleum, they changed their name from, they used to call themselves as oil company, but now they are calling themselves as integrated energy company. So by the name, it looks like that they are completely operating in energy segment or renewable segment. But while if you see, 90% of their annual spend is on oil and gas, but still they are advertising as such that they are green. So that is a classic case of greenwashing. Similarly, for Volkswagen, they claim that their vehicle do not pollute and they emit lesser, they have lower emissions. But when the test was done, in reality, they were polluting 40% more than the allowed limit. And one of the classic cases is Goldman Sachs. US SEC, they levied a penalty on them for fouling the governance policy and procedures. They were penalized of 4 million USD. And similarly, fashion brands, H&M, Zara, they keep coming up with that their clothes are sustainable. But if you see, they contribute to massive amount of textile waste. So that is also a greenwashing. Yeah. So to avoid greenwashing and to make investors aware, SEBI has mandated, as far as debt issuances, green debt securities issuances are concerned, we have mandated Principle 6, that is related to environment disclosures of BRSR. So issuers who are raising green debt securities, they have to mandatorily disclose e-component of the BRSR. So currently the BRSR is normally applicable for top 1,000 equity listed companies. And that entire BRSR comprises of ESG part. E stands for environmental, S stands for sustainability, and G stands for governance related. But as far as green debt securities are concerned, we have only picked E part of, to begin with, we have only started with E part of the ESG related parameters. Now, if you see, Nikhil was mentioning that there have been very lesser number of issues, and if you see the outstanding amount is only approximately 5,000 crores of green bond issuances. So one of the issue might be lack of awareness and thereby lack of demand. Investors might not be knowing that there is such avenue. So we can provide trainings, we can, our OIE department do conduct awareness campaigns, and then supportive regulatory environment. So to do that, we have, SEBI has already revamped its framework. It has aligned its framework with globally accepted ECMA's GBP principle. Shortage of qualified projects. So issuers think that there are shortage of projects eligible for green projects, but that is not the case. If you see the scope of definition, it is very vast. Be it green buildings, public transportation, or any activity related to water. So classic example would be, for example, Pradeep sir was mentioning in the beginning about municipal bonds. So municipal bonds are issued by municipal debt securities. So if we talk about municipalities, they operate in this area, they do civic duties. So most of the projects that are carried by them, those are eligible for green projects. So recently in February, Indore Municipal Corporation that came up with that was first public issue of green debt security, and it was oversubscribed by 5 times. So from there we can see that there is a demand of this instrument. Okay. So now in the budget also, India in last year's budget, it focused one of the pillar out of those 7 pillars. One of was green growth, and for that government has launched mission like green credit program, national green hydrogen mission. For that government has planned an outlay of 1700 crores for green hydrogen mission. So yeah, that's it from our side on green bond framework. So we'll take the questions in the end, or we can take it now.
Thank you very much. Thanks, Priyanka and Nikhil, for giving very extensive, very useful presentation. We will take up question at the last. Okay, so because there are so many things which are there, it is already covered in the consultative paper. So I will request Ankit Singhi to give a presentation on this consult paper's main point. And then I'll request Meeta to say point on this, and then we will take question answer. So Ankit Singhi, please.
Hi, good evening, everyone. I hope I am audible.
Yeah.
Okay, so we'll now discuss the key propositions that were made as part of the consultation paper. So if you see in terms of consultation paper, I believe 2023 has been a historic year, I think, for SEBI. In terms of in last 3-4 years, this is the highest number of consultation paper that have been introduced only during a calendar year. I think in 2023, up till now, 53 consultation paper have been issued as opposed to 19 in 2022. The sheer number of difference in terms of 19 to 53 shows how active has the regulator been throughout the year. And the latest one, the one we would be discussing today on the changes that have been proposed under the regulatory framework governing NCDs and NCBRS. So if you see the most of the points that were discussed in today's session so far, even what point Mr. Pradeep raised, I think the overall objective behind this consultation paper and other actions that have been taken so far is to make the bond market more buoyant. And I think one of the key takeaway that I can take from this consultation paper is to extend the participation from institutional investors to the retail sector, where public at large, like they invest in an IPO of an equity based company, they also start showing larger interest in debt related issues, whether it's a private placement or it's an IPO. And if you see with the increasing in number of online bond platforms that have emerged, I think this year itself, there has been a considerable shift in terms of traction towards investing in a debt instrument or a bond, as opposed to an FD and other safe modes of investment. But I think in terms of, if you see the data, participation by retail investors, mainly public, is still on a very lower scale, as opposed to institutional investors, which invest bulk of the investment. And as Pradeep said, I think 10 lakh crores, something 2 lakh crores was raised through equity. So it also highlights the amount, the instrument, extent to which this instrument is being issued for raising funds. So I'll discuss in brief the proposals that have been outlined in the consultation paper, and then we can put that to the floor to take views of other participants. So the consultation paper was issued 9th December this month, and it has a deadline, I believe, of 30th December to submit the recommendation on various proposals that have been outlined. So I'll take all the proposals one by one, and then we can discuss that. So I think the first and most significant proposal is with respect to reducing the face value of privately placed NCDs and non-convertible redeemable preference shares from ₹1 lakh to ₹10,000. In the discussion paper, first it is important to note that this ₹1 lakh has also been reduced from ₹10 lakh this year only. And if you read the consultation paper, I'll highlight the fact that soon after reducing it from 10 lakhs to 1 lakh, there is some change in the degree of investment in this instrument. But still, I think what SEBI has identified in terms of their own research, that still institutional investors are the primarily investors in this market. And in order to ensure that wider retail participation or non-institutional participation is motivated or facilitated in this segment, it is also important that the face value is brought to a amount where it is easier for such segment to invest. A 1 lakh rupees in a lump sum in a particular instrument, it will still many segment among the retail investors find it difficult to invest. So the proposal is to allow companies to come out with a face value of rupees 10,000 as opposed to 1 lakh rupees, which is there currently. And in order to safeguard the interest of the retail investor in all such issues where the face value is rupees 10,000, the company issuing the NCDs or the preference shares on a privately placed basis have to appoint a merchant banker on a mandatory basis, and merchant banker has to undertake necessary due diligence in order to ensure that all relevant disclosures have been provided in the offer document, and merchant banker has looked into the credentials and other aspects of the issue. And so because once it is reduced to 10,000, it will be open to a much larger audience to invest. So ensure their interest is also safeguarded. Companies can opt to 10,000 rupees as a face value, but in that case, they have to mandatorily appoint a merchant banker, which is not the case currently. So there are some questions which have been posed by SEBI on this, that do you agree with the reduction in face value of the privately placed debentures along with proposal to appoint merchant banker? Do you agree with the proposed requirement of appointment of merchant banker? So these are some issues which are there. Even in the securitized document instruments, they have also now allowed, because there is currently no face value per se which have been provided under the regulation. But as part of one of the proposals under this proposal itself, that is, they have also mandated all companies issuing such kind of instrument to mandatorily appoint a merchant banker for all the issues, irrespective of the size issue of or the face value of the instrument. While in case of a pure debt instrument, it is in case you have a face value of 10,000, you only need to have a merchant banker. But in case of securitized debt instrument, in all the issues, the privately placed issues, they are mandating a requirement to appoint a merchant banker.
Ankit, I just asked Meeta. Meeta, do you think these two changes will bring some drastical involvement of the retail investor?
Yeah, I think so. One of the primary things, sorry, am I audible, Pawan?
Yes,
yeah.
Okay. No, I think so. And we certainly hope so, because once listed, right, for instance, public issuance, face value goes down to as low as 1,000 rupees. And it sort of incentivizes strongly retail participation in these issuances. And once listed, privately placed or public issuance, once listed is transferable on the stock exchange just as the other one. So when you reduce the denomination, you increase accessibility. And, like Ankit was saying, that the consultation paper sort of records and gives you data. It actually suggests that there has been a 4x increase in participation from when the price was face value was 10 lakhs and brought down to 1 lakh. So I think 1 lakh seems still a little expensive for a retail investor participation, but we think 10,000 sounded like a reasonable number that an investor would be willing to invest and participate in. And that, coupled with sort of assurance that there was a merchant banker appointed on the deal who would do the diligence to ensure that the retail investor was well advised on the risks and the diligence was conducted in depth. I think that was generally the approach that we took when we deliberated on the matter.
Okay. So, and about the merchant banker point of view?
Yeah, I think it's an effort, Pawan, to sort of suggest that having a SEBI-regulated intermediary not only arrange the issue, but also be relevant in the transaction from a due diligence perspective, we felt added a certain degree of integrity and quality of diligence, which could reinforce the retail investors' sort of faith in the quality of disclosures, risk factors, etc. on the issuance, which is why we thought it was a good idea to, while we're reducing the face value, the initial sort of reaction was, or the worry was, that if we're reducing private placement face value to an extent that is very accessible, are we at the same time also securing and ensuring that the investor concerns are protected? SEBI wears multiple hats. One hat is to obviously deepen the bond market and therefore aid issuers in that process. But the second and the most important and almost contrarian hat is to ensure that while doing so, you are keeping in mind the investor's risks, protecting the investor, ensuring that the investor is educated and aware of what the quality of the security is. So to that extent, we felt that this sort of balanced the option out and could be considered.
Okay, Pradeep and Nikhil and Priyanka is here. I'm just asking one question, that now you are saying that you should have a rating also, and the rating should be good. So why can't we allow AAA rating companies that in place of this 10,000, 100 rupees or 10 rupees, they can apply? Because earlier the cost of acquisition was very high. Now this is all technical, this is all technology based. Whether you invest 1 crore rupees or 1 lakh rupees or 1 rupee, you have to put the order in the system. So do you think in tomorrow there is a possibility that the retail means the actual general public, with this rider of AAA rating, you allow them 10 rupee or 100 rupees of 1000 rupees denomination?
So I'll just try to attempt to answer that question. See, if you a few years ago, the price of one privately placed bond was 10 lakh rupees.
Yes.
Right. So just a year back, it was brought down to 1 lakh rupees. That is 1/10.
Yeah.
Right. It was brought down to 1/10 of what it was. Now we are bringing it by 1/10 again. So which means to 1/10 again, which means the intent of the regulator is to make it accessible to more individual investors. So that is the idea behind this. But if you look at the preamble of SEBI, it says that we have to, while develop the market, we also have to ensure that we protect the interests of the investors. So we will have to do a tightrope walk here. And so while we are trying to bring down the face value and the trading lot of a privately placed bond, we want to bring that with certain safeguards. While there is no denial that a 10,000 can even become 1,000 tomorrow with all these things, the fact is that if these things are helping the market to sell to more investors with adequate protection, this can perhaps even happen in future.
Okay. Okay. So the future will we will see this. Okay, Ankit, next point.
I think the second is with respect to doing away with the requirement of publishing the financial statements of last 3 financial years and the stub period in the offer document, where there is a current requirement, and SEBI has pointed out certain hardships in doing so, and the time taken in putting all these in the document and generating a lot of SRNs and other numbers. So all this takes a lot of time. So they have suggested a proposal to do away with the requirement of publishing these results as part of the offer document. And instead of that, a web link or a QR code can be provided, where the web link or the QR code will take it to the website of the issuer company, where they can refer to the financial statements of the last 3 financial years. So I think similar things can also be done in other issuance by other companies for other instruments, where is also a need of providing such details of 3 financial years and other period. So this is I think a technical change, nothing much to do. Sir, you want to have any views on it?
Okay. So Meeta, first your point. What is that this change will bring? What are the other than the practical aspects, any other thing it will bring?
No, I think the clear sort of mandate from the budget speech that you were referring to and SEBI's sort of approach and focus has been ease of doing business. Now, this could sort of move into various categories of, principal regulations, of operational mechanics, of accessibility. There are various aspects to ease of doing business. This, I believe, is the operational aspect, where based on public feedback, and there was overwhelming feedback received on, previous consultation papers that were put out. I'm sure you yourselves have commented on quite a few of them when there were comments open for ILNCS, LODR, all of them in November. So we received a lot of comments that said, hey, look, the process seems cumbersome. With technological sort of updates and alternatives available which provide equal, if not greater, integrity in terms of document disclosures and sharing, should we not adopt that? And I think SEBI has been progressive in that regard to sort of continue to support and encourage technological developments. And this seems, to our mind, like an easy fix. It's not doing away, Ankit, sorry, just to sort of refer to that a little bit. I don't believe it's doing away with the requirement. It's just an easier way of uploading the document. It's just a QR code and a link now, and it's the same disclosure, the same document. And we're also hoping that with these things, it's just easier for the investor as well to access information, as opposed to going through a bulky report of 400 pages. They know exactly where to look for things. And with our younger investors becoming more and more active and more savvy, I think it's just required for the regulator to sort of keep up with these kind of developments.
Okay. Next point, Ankit.
I think other is with respect to, there is also a requirement of outlining certain details as provided in Schedule 1 of the regulations, where you need to provide details with respect to certain changes in the board, auditor, changes in defaults. And there are a lot of items that have been identified, including related party transactions, remuneration of directors. All these things are currently, this is a requirement of also submitting the details for the relevant financial year in which the issuance is being made. I think SEBI has received representation from the companies as to this creates additional obligation on them to do certain other accounting related aspects at their end, which increases the timeline to prepare these things. So SEBI has suggested that they can prepare all these disclosures up to the date of last quarter, where in that case, generally these companies are preparing results or other document till last quarter. This will help in squeezing out some time because the data otherwise, financial statements would otherwise be available with these companies. So that will help them to quickly prepare the data out of those documents, and then avoid the detail of preparing for the stub period in between the quarter and the day when you are proposing to file the offer document. So you can avoid that time. So to create further ease, they have restricted it to the last quarter before the filing of the offer document, up till which you can give the relevant details as required under the schedule.
Okay. So Meeta, your view on this, and Meeta, I am asking questions on this. Then whatever remaining is there, you can cover after Ankit.
That's fine, no problem. My view on this, well, I think this is more of a sort of technical account that SEBI is sort of considered while comments have come in on this. So maybe on this one, I'd invite the panelists from SEBI to share their views.
Priyanka,
Pradeep, Nikhil.
Pradeep, anybody.
Yeah, so since we agree, that is the reason why we have put it on the paper.
Okay.
So essentially, so we believe, as I said, it's a tightrope walk, and we have to ensure that the larger details, the larger things like reduction of face value and a faster public issuance, etc., are sort of buffeted with with more disclosures. So essentially, SEBI has made a transition in 1991. India has made a transition in 1991 to move away from merit-based regulation to disclosure-based regulation. So SEBI will not be sitting in judgment on who is going to come with a public issue or the eligibility of the issuer. So if you are going to remove that, then we have to ensure that the person who is going to invest in the company to take a call. So if the person who is going to needs to take a call, that person needs information. So to that extent, the information has been, but in fact, like Meeta rightly said, this is actually not too incremental when compared to what is already existing. This is a very, very small appendage to what exactly is already existing.
Okay. Okay. Next point,
Hmm.
Ankit.
So this is another change where they've provided that the record date, the gap between the record date and the due date. Currently, there was a lot of variation, I think, with SEBI saw in different periods being fixed by different issuers. So to ensure that there is a uniformity in the record date and the due date of the payment of the dividend or the interest, now they have mandated that in all the cases, the record date shall be at least 15 days before the due date of payment of debt securities, so that there will be uniformity in all the practices being followed by different issuing companies.
Okay. Meeta,
So I think,
yeah. Meeta, do you think this
No,
will?
I think.
Yeah.
Yeah, I
Yeah,
think just
Meeta.
quick thoughts on this one, Pavan. I think there has been a fair amount of inconsistency. A record date is relevant to sort of identify who gets paid out the coupon or the redemption on that date, and also to identify if that entity can or that holder can transfer during that period. With standardizing this, it makes it easy for issuers. It also, more importantly, makes it easier for investors, especially investors holding a basket of investments, because then they don't have to sort of go back to each bond document and take a look at what was the record date under that relevant bond document. Given that this process is relatively standardized, we felt that it was in the issuer's interest to ensure that there was a standardized sort of approach on this one.
Okay. Ankit, next
bring
point.
a lot of ease for the investors.
Yeah.
Ankit, next point.
Due diligence certificate. So under the NCS regulations, specifically under regulation 40 and 44, there is a requirement of submitting a due diligence certificate by the debenture trustee. In some substance, both the I think certificates talks about in a way similar content about creation of security, creation of necessary charge on those security, ensuring all charges have been created, due security is there. But there was a difference in format in terms of one is required at the time of filing the offer document, one is required at the time of filing the application for the listing of the instrument. So in order to bring or align both of them, there is a proposal that the certificate format will be aligned, and there will be one common set of certificate that will be issued in both the cases.
Okay. I think, Meeta, this is a good suggestion because now standardization is required for all these things. And Pradeep, I think this is a good proposal and change which will bring uniformity and less cumbersome.
Yeah. This is really ease of doing business.
Yeah, that's right. So for ease of doing business, Pradeep, you were in the Secretary Standard Board also. Everything should be standardized now. Everything. And it will reduce time of regulator also to check, and the professional also, and the corporate also. So same
Yes.
thing, same due diligence report mean all law firm and people are giving due diligence report. Their format and things system should be the same, except the content.
Yes.
So
So
next,
the idea
yeah.
of standardization is to remove the haziness surrounding certain points, and it also removes the possibility of interpretational vacuum, right?
Yes.
Some vacuum that could be created by interpretation. So that is something which, and many times we feel that intermediaries, as much as intermediaries and companies grumble about more circulars from SEBI, they in fact want circulars from SEBI describing standards as well as formats for everything that they have to do so that they can stick to the format.
Yes, absolutely right.
Yeah.
Next.
So next change, I think it's also another welcome change where I think currently companies listing their NCDs are required to fairly publish their result, and there is a requirement of publishing the financial results in newspaper within 2 days of the meeting where the results are declared. It's important suggestion that the is made in the discussion paper where they are making it non-mandatory for companies to publish the advertisement in the newspaper. And the reason that is being given is that the result are already published on the website of the issuer. It's also made available on the website of the exchanges, also including debenture trustee. So there is much more room where these results are made available to view online. So as a result, issuers will have an option to whether to decide to publish the result in the newspaper or not. I think important thing to be taken, I think Pradeep can guide whether this will in any way also move on to the equity listed entities. I don't think, but though it is not his domain, but I think this is important
Out of syllabus question should not be asked.
development.
Okay. So Meeta,
So I would like to skip that
yeah.
question. I would like to skip that question. So the idea here is, okay, let me just give you the background behind this. While of course we are still in the receipt of comments, the idea behind this is today is the internet age. Almost 50 to 52% of India is already connected with the internet.
Yes.
And today, if I'm going to release the results today, publishing the results in an internet age, in an information age, 2 days after this, actually it's only burdensome on the company and does not add any value to the market that is already in possession of this information. Today, this information is available on the website of the stock exchange, website of certain financial papers, and it also it's on the website of the company, because a functional website has to be maintained under 62 of the regulations. So this information is already there. So a publication, while the public, we are not saying, we are not doing away with the publication. We are only saying that if should you choose to do it, you do it. It's your choice.
Okay. Okay. Yeah, Meeta, you have any point on this?
No, I think it's a good green move, and I think good indication for other teams in SEBI as well.
Okay. Ankit, next.
So we'll now move on to the next part where there is a concept which has been introduced by way of fast track public issuance and listing of debt securities, and certain proposals have been mooted there. So SEBI, I think it's part of the report, mentions that 98% of the debt issuance is through private placement, limiting public participation, and there is also a need to allow companies to create a route where they can access the market fastly in a much better manner, so that the bond market is also deepened and larger participation is allowed to the public investors. So in view of the same, they have recommended concept of fast track public issue and outlined a list of eligibilities that companies who fulfill those criteria will be eligible to take this route, and also outlined how the fast track public issue will, in a sense, drastically reduce the timelines one need to go public in terms of the current process and the proposed process. So there is a requirement in every issue of a generic document and a key information document. They have provided that there will be a common document for public issues and private placements, and then there will be a key information document that would be having specific information with respect to that particular issue. And considering public issue and private placement, they will have a different set of disclosures. Similarly, they have also outlined an eligibility criteria for issuance. So apart from the current eligibility criteria that is there in terms of a willful defaulter, a fugitive offender, no default, a lot of other issues that have been outlined to be an eligible issuer for being eligible. They have outlined additional requirements where they've talked about compliances, compliant with the listing regulations. If you should have existing track record of listing of either NCDs or specified securities with the exchanges, credit rating of not less than AA minus, and no significant defaults and regulatory actions that are pending against the company. So if you are meeting all these conditions, then you would be eligible to take the fast track public issuance route and save a lot of time. Then they have all. I will just go through all the proposals in this connection, and then Meeta and Pradeep can come across to share their views. Similarly, they have also reduced the time for public comments to 2 working days in case of a fast track public issue, which will definitely reduce or save a lot of time in receiving comments. Disclosures have already outlined that to the extent they have standardized the disclosures in GID, and then KID will be having different set of disclosures considering the nature of the issue. then issuers will be allowed to do away with the requirement of mandatory newspapers if they don't want to, and they can use the digital modes available in order to publicize the issue to the public at large. Even the subscription period, they have also suggested that it can also be has to be open for a minimum period of 1 working days and a maximum period of 10 working days, which there can be a period of 1 day of extension in case of revision in the period. This is also a welcome move where you can keep it open for a shorter period. Another important point is, I think this is one of the most significant point, is that currently oversubscription is only allowed up to 100% in any public issue. And I think there is, in the discussion paper, there is a proposal to increase that to a maximum of 5 times. So that would be 500 times of the issue size. So I think this would definitely create more traction for issuers to go to this route. Then timelines have been also been reduced from T+6 to T+3 as part of the proposals under the document. So in sum together, there will be a lot of saving in overall timelines if one adopts the fast track public issuance and go for listing of the debt securities. So these were some of the key proposals. I think now Meeta and Pradeep can share their views on how they see that, how this proposal taking shape and what were the key considerations behind it.
Yeah, Meeta, first you can comment on this.
Sure. So I think the aim of fast tracking was one, to primarily make it easier for the issuer to access the public issue market. And while doing so, I think one consistent thought that occurred through this process was that it had to be a credible investor, an investor with repute, an investor with enough experience in the debt market, an investor that public issue, you would still continue to protect the interest of the investors while undertaking up a public issue on a fast track basis. So while balancing these two and keeping in mind that this was a track that was open only for credible investors, a certain sort of eligibility criteria was discussed. Like Ankit was saying, that we will ensure that the investor has had listed securities for 3 continuous years, has never defaulted in its payment obligations. The issuer has a minimum credit rating. All of this to sort of give them the benefit and access of a fast track process. Typically, public issuances, as you may be aware, a lot of you on the call may be aware, is a fairly long drawn, cumbersome process, relatively speaking, compared to private placement. It takes anywhere between like 90 days to 150 days usually to sort of complete a transaction. The aim of the fast track process is to reduce the timeline, make it easier, make it faster, make it potentially cheaper as well, to be able to sort of execute these transactions. I think one of the other significant moves that have happened this year, and kudos to Pradeep and his team, has been the introduction of GID and KID. The aim is to have GID as a standard document that has standardized disclosures that continue to apply for all issuances, with KID being the option for dynamic disclosures, ongoing disclosures, matters that are constantly updated. So I think what this does is it sort of reduces the bulk and the form of the offer document, making it easier for issuers to issue, and also, more importantly, making it easier for the investors, especially on subsequent issuances. So I think with that move as well, not only has that sort of eased the process from a private placement perspective, we think introducing that on fast track for public issuance is also significant. Pradeep, over to you in terms of what thoughts were in relation to the fast track process.
So, Meeta, you have really succinctly explained the mind of the regulator in this particular issue. So just to add a couple of points to what Meeta has said, the reason, a couple of things. In the last 2 years, the OBP reform has ensured that there are more individuals who have come to the market. As during the course of my opening talk, I said that the last 2 quarters, we have found the retail participation increasing from 1 to almost 4% in the market, which means that a lot of retail investors are also looking, individual investors rather, I won't use the word retail, individual investors are also looking at bond markets as a mode of investment. So we thought that why don't we, because if you look at the public issue process presently, for almost 1,500 private placements, there are sort of 40 public issues during the year. And the equation is so lopsided at almost 98:2 or 99:1. So by making companies tap the market, one of the things which has been used for the purpose of not having so many public issues, when we did a cursory pre-consultation paper study with stock exchanges, merchant bankers, lawyers, and other market participants, is that they said that the problem is that it is a little too cumbersome because of the time taken and the procedures involved. So we said that now we found that already SEBI has brought in the concept of a fast track public issue. It's not new. We already brought that in the when it came to equity. So we thought, why can't we replicate a similar model here? In fact, it is easier because in this debt document, SEBI does not offer observations. But as I again go back to what I said earlier, whatever reform we bring, we have to do a tightrope walk. As much as that we are freeing up for the development of the market, we also have to ensure that there are certain safeguards for investor protection. So keeping these two things in mind, we have brought these proposals. We really hope that this this is really after receiving comments and once this becomes law, this is really something that is lapped up by many issuers, so that they will be able to. And the one other thing, like Meeta very rightly said when she started, the GID and KID reform is something which we expect to be taken in a very positive way by the Indian corporate, by the issuers. So by extending the GID and KID, we are making that the cumbersomeness associated with the further filing go away. So these things should sort of even bring us today. Preparation of the offer document, when you look at an informal chart, it takes T plus 70 days. Right? So those things will be sort of mitigated once this comes. So we really hope, as much as private placements, public issues also find flavor. See, one other reason is that private placements generally go to the people who already know about the market. Sometimes public issues, you can reach out to other people also. The universe of people who can invest in your company actually increases.
Okay. Pradeep, now this is absolutely right. There are one issue which I'm not able to understand on the jurisprudence part. One is, you are saying that now minimum subscription will be out from this thing. Is it right?
Minimum subscription, we are expecting minimum subscription to be removed for finance companies and companies which don't have an object. So it is for those companies. The idea is, if you go back to equity, there is an object to the issue, and there is also something called a means of finance. So if I'm going to build a bridge, or if I'm going to build a building or a printing press or whatever, so I know that there is going to be some amount that is associated with this. Whereas mostly for banking companies and finance companies, infrastructure and NBFCs companies, infrastructure financing companies, they specifically don't have an object because their basic object is borrowing and lending. So in such cases, having a minimum subscription is something which might act as a spanner when it comes to choosing a public issue as a mode of offering. So removing that will actually come. If I were a finance company intending to tap the market, it will be music to my ears if I choose to adopt the public issue route.
And what about the manufacturing company?
So manufacturing companies will have a project, right? So in case they have a project, they will. So the thing is, the whole purpose of taking money, the whole purpose of having minimum subscription is for twofold. One is there is adequate interest in your company. Secondly, the project should not suffer in case you are not able to raise enough money from the public. So that is capped at, say, 90% in case of equity and 75% in case of debt. The idea is that in case you're able to raise 75 rupees from here, you will be able to raise 25 rupees from somewhere else so that the project does not suffer.
Okay. But what is the logic behind this concept of these 5 times? Now, suppose I am a finance company or I am a manufacturing company and I have a plan. So is it not a right thing that we should say, in case you are getting over subscription, you can retain up to 5 times, but you have to tell in advance that where you will utilize this fund?
Yeah, so this is something which we are just consulting. We have brought this idea from the present requirement that we have brought in for the EBP requirements for private placement. We thought that we may perhaps, I mean, we could perhaps bring this for for public issue, and we'll consult. So I may not want to comment on that, because I want to wait for public comments on that. You have a very good point in saying a why. A why is a very good question there. Our
Okay.
thought process is that we can, since it's fast track and also replicating the model that is already used in the private placement market, we wanted to bring it.
So Pradeep, for each question we have done the poll also. So
Yeah.
we get the view, and then other people have also sent us the question. So we'll compile it and send it to you. Our
Okay.
view, then the today's discussion and these
Yeah.
points. So now I think Ankit, your all points is over. Now I can.
we have covered
Yeah,
everything.
Meeta. Now you have given your view, but your point of view relating to this, how this market can develop, how things can be, your view.
Right. So I think, I mean, firstly, thanks for having me. It's a pleasure to sort of share the panel with Pradeep and his team and Ankit and you. I hope this has been an engaging session. In terms of what I think and why it's relevant, like you noted, Ankit, it has been an extremely active year, keeping up with regulations, keeping up with consultation papers and constant updates. But if anything, I think that's a comment on SEBI as a listening regulator. They have been very responsive. They have actually, I would say, ahead of the curve in terms of market developments. They've been consultative in their approach. We've got stakeholder discussions at every level, and I think the working group is an example of that. The working group is an industry representation of people, issuers, investors, lawyers, intermediaries, everyone bringing to the table what they believe is market experience, what they believe is market expectation. We're constantly nudging the regulator towards setting new benchmarks, comparing ourselves to other jurisdictions and other regulators, and ensuring robustness of the market. I think the deeper the corporate bond market in any economy, the more sort of robust that economy is going to sort of reflect. And we have a long way to go, but a significant stride made this year. And I think I'm only hoping that we continue to keep that pace. Just in terms of a background on what we've done in the working group, it's been deliberations, often enthusiastic discussions. But yes, it's been a long process, constant discussions. And this is just one part of it. There is currently deliberations going on in terms of EODB, for the other aspects of ILNCS and LODR as well. We're looking at two parts, I'd like to say, Pradeep, and let me know if that's correct. We're looking at one in terms of ease of operations, and a lot of comments received on that. And I think we're trying to compile and find manners and ways, and potentially even doing dry runs before these are offered as options and alternatives. The second is more principle-based questions like the ones you asked, Pawan. There is no question that's not on the table as far as the working group deliberations are on. Why do we need it? Do we really need to take a look at this afresh? Can we make this simple? Is everybody else stipulating this similarly? Is the same information being provided otherwise in other forms? Do we need to do this all over again? Are we making it clear for the investor? Is there a data overload on the investor? Are they even, being told what the main important aspects are? Is the issuer able to get away with, a significant data dump without actually looking at the spirit of the regulations? Such questions that we sort of think about and deliberate on. And I think you should expect some more movement on this. Like I said, there is ongoing discussions, and the second part is sort of the second part of the progress or the suggestions will be focused broadly on these aspects. But as far as this is concerned, I think the fast track move is a significant one. We're really hoping that this is something that resonates with the market. We're hoping that we see issuers enjoy the benefit of access to a fast track issuance. And more importantly, we're hoping that as the market gets deeper, education around products like these become better forums like yours are certainly critical in sort of communicating the message. I'd also like to congratulate the regulator and the team for being present, to take questions such as this, to be accessible, to be sort of forthcoming in responses in terms of what their thought processes are. I think it's fantastic, and I think soon we're headed to a multi-trillion-dollar economy, and there is no way else but forward in terms of the bond market. I think at least that's been our approach on the working group.
Okay. So very nicely summed up the issues, how you have done this. And no doubt there are so many things. Pradeep, two things very important which I want to ask. Municipal bond is also very important for the development of the grassroots level. But municipal managed by the politician. So how as an investor I can have a faith that this municipality where we are listening every day that they have done the siphoning and they have done this, I will put money in municipal bond. I can put money in the government, central government or state government, but municipal bond, how I will have a faith?
So Nikhil and Priyanka, would you like to go for it? Then I'll supplement it.
Yeah. Okay.
So yeah, sir. So first of all, the framework that is there for municipal debt securities, if you see, we have revamped in 2019. Also, we have brought additional requirements. We have brought a 4-tier structure wherein there is a fund requirement, there is a sinking fund, there is a general fund which is there. Then there is a specific interest redemption fund is there. So on a timely basis, the municipal corporation itself is supposed to keep crediting the amounts that are going to be paid at certain intervals. They are supposed to keep it inside those funds. And if you see, there is for example, if you compare with a normal bond and a municipal bond, appointment of a debenture trustee, appointment of merchant bankers, all these things are present, and their due diligence is on a continuous basis. May not be for a merchant banker, but for a debenture trustee, the due diligence roles and responsibilities are specified on a continuous basis, and which if they themselves do not carry out, then that becomes a bad reputation on their part. So a whole framework of intermediaries, and even from the municipal corporation side, if you see, there is a particular single point of authority is there who particularly signs on that, and they are also very much so we have been doing a lot of municipal bond workshops for the last 1.5 years, and over there we interact with these municipal commissioners and the office bearers of these municipal commissions, and they are also very much willing to take responsibilities for the amounts that they are raising. So it's not like there is not a proper structure in the intermediaries as well as the issuer, that is municipal corporation in this case. So they are also very much vigilant in their own responsibilities. Sir, and maybe
So Nikhil has Priyanka, please.
Priyanka.
And for the protection of investors, sir, one of the differentiating factor between municipal debt securities and NCDs is escrow mechanism. For municipal debt securities, we have prescribed escrow mechanism. So basically, if a municipality is earning revenues, it will first go to that escrow account, and all the payment obligations, including your interest payments, debt service coverage amount, all those things will be deducted. Then only that amount will be used by the municipal corporations.
Okay.
Yeah, so I think Nikhil and Priyanka have very succinctly summed up the reason. So while we wouldn't want to, as a regulator, call that as protection, but I would like to say that this is something which has been done, which generally is not there in case of municipalities. While we understand that countries like US, where there is almost $4 trillion of outstanding as far as municipal bonds are concerned, and something that is very overwhelmingly vibrant and liquid, the fact is that it is because of the fact that there is a lot of tax breaks that is afforded by the government there. But those companies can actually file for bankruptcy. There is a Chapter 9 filing as far as bankruptcy of municipalities is concerned. So this is something, and even big ticket municipalities like California have filed for bankruptcy. So if I may sort of appraise this group. But as far as India is concerned, like one is of course these things which Nikhil and Priyanka said. So those things are anyway there. But over a period of time, there's a possibility that we may even look at this particular further protection, and in a way, so and permit me to use this word, and it may not be right. So I wouldn't say that they are sovereign, but in a way, there is something a lot more solid about them as compared to maybe a new corporate, right? So to that extent, I believe, because they are attached to a state, the state is not going to run away with the money, right? The road is anyway going to be there. The bridge is anyway going to be there. The desalination plant is going to be there. So to that extent, I think, and municipalities are not going to take money for lending and borrowing, right? They anyway take money for a project that is very clearly laid down in your regulation also. And like Nikhil and Priyanka said, the concept of the escrow and sort of keeping it in one place, it also helps them to sort of service the debt that they have taken from the public.
Okay. So I think this is perfectly right. So Pradeep, what I'm doing, I'm just showing you the poll which we have done, but I will just summarize this point, and then as a ritual, we are asking last comments from every participant. So for the growth and development, you can suggest. Okay. So this is do you support the recommendation of reducing denomination? I think this is a 94% people are saying, so this is good. Next, should QR codes is offer document mandated? 70% say yes, 19% say no. So no people, those who are saying either, those who are saying no, please specify that why you are saying no, so we can write to the SEBI that why this is not required. Next, do you agree that the proposal including additional detail of RPT director remuneration is an NCD issue? 46 strongly agree, 36 I think 18% is most.
So we can take it as 82, yeah.
Yeah, 82 we can take, but 18% why they are disagree, you please write to us. We will definitely write. Next. Is standardization of shut period for NCD issuance necessary for stimulating process for timeline? 67 is necessary. 17% say unnecessary. So unnecessary, please tell us why this is unnecessary, so it can be give the right view. Do you believe in harmonizing due diligence certificate? I think this is overwhelming, 93% and 0%. So Pradeep, the standardization, you must.
I would like to know who ticked unsure here.
No, because unsure is they unsure mean they are saying that maybe they
it's
are.
Like, do you want a gift from Santa? And someone is saying, I'm unsure. Okay.
Yeah. Okay. Next is should publishing financial result in newspaper be optional for companies issuing LCD? 79% say yes, 18% no. It should be no. It should be mandatory. Unsure. So I think 80% people are in favor. Are you in favor of introducing fast track process of public issuing listing debt security like NCD? So I think 96% people are saying yes. So that is another positive point which you are recommending. The next is okay. So these were the poll.
No,
which
thank you. This is very, very, very useful. Yeah. And I would request you to share this, so we will be able to share with the top management. And this is very nice, very nicely, beautifully compiled.
Yeah, so we always in the program when consultative paper and something is there, we are asked this question in the last. Now I have because I have to summarize, so I just want to I raised some issues. So Shivam, just can you show? So I have compiled this, that issues in the retail bond market solution. So lack of awareness and understanding. So financial, this is not related to concept paper, just I'm giving the macro view. So financial education and awareness program is very, very essential, which you have done for equity market. The bond market should also be there. Like just now you have taught me the municipal market, the escrow account and this. No doubt I should read this, but I'm not interested to read. So, and I want to be investor, but I'm not putting money. Limited accessibility and distribution channel. So that is another part. The channel is limited. The equity market brokers are there, but debt market, very few people are there. Liquidity concern is there. I want to sell this unless I'm aware that this mechanism is available. People will be shy away because this is a direct competition with FD market. So if I'm coming, So you can start a market making concept or some concept where the people can get some advantage, because when I'm going for I'm asking my FD, they can change this or give me money, so they charge money. So same way you can also do this. Risk prospection and the preference of high return investment. Now equity is a more returnable, here it is less. So you have a database of the investor. So if you can identify that who are the less risk taker, you can communicate to them. Regulatory framework and market development issue that you are doing support, and you have to do this. Lower return as compared to equity, that is one part, and I have told you the same thing can be helpful. Preference for traditional investment avenue, showcase bond as a modern and viable investment option. And what you have shown relating to this, that how this green bond and multiple bond and ESG concept is there, which Nikhil has shown. That concept can also be there. So people should invest money not just for the sake of return, but they are thinking that this is, I'm doing something great for the environment also. So that you can attach that education can, and then that way can be very useful. Minimum investment amount may be prohibitive. That is, you are doing this. Technological utilization is there. And because of this, you have come to 10,000. You can come tomorrow at 100 also. And day after, this is 1 rupee. Because why I'm saying, have you listened that, heard that you can buy gold of 1 rupee? Nobody has seen this. But you go to Paytm, you go to various sites, and you can buy 1 rupee gold. So I want to buy gold. This is my passion, but I don't have money. So if you can buy 1 rupee gold, so why not I can invest in 1 rupee bond also. So that is one part, technology can be helpful. Need for tailored financial product, offering diverse bond product catering to diverse investors' need. That is one you have done. We have a green bond, multiple bonds you can start. And sometimes you can start the bond which you have a mutual fund type of thing, that this is going for the hospitality, this is like all the companies, the mutual fund type of things you can start, that this bond is for infrastructure company, this bond is infrastructure bond. So some new name can come. This is for FMGC product. So company which are coming out with this bond. So new concept of mutual fund type of things can create. So this is few suggestions I have given, which will compile it and give it to you when we'll give. So
No, very, 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 very beautifully done, and this really will be useful to us. Really, will be useful to us.
Yeah, I have detail also. So
I should really compliment the seriousness with which webinar is being conducted by corporate professionals, and you also have taken the have taken the pains of doing survey, which will be useful to the regulator also, and I should really compliment you for that.
And I'm very sorry, because this is a very technical topic, because if you remember, you are all the professional in the exam, debenture trustee, and this is the boring subject, and we were never studying this, and we were leaving this. So the same thing happening with the investment also. So thank you very much to all. So I will start with the Priyanka.
Thank you.
Your point of view, so you can just summarize in how this can be useful for this. So Priyanka, with you. Yeah.
So, sir, I would like to thank corporate professionals for conducting this series of webinar. So it will help us also as a regulator, because it will create awareness among the participants out there in the market. Like you were saying that debentures, this subject is boring for you, but hopefully we expressed it in some interesting way. So you all would have understood what NCS regulations are, LODR regulations are, and there are various avenues present for you to invest. So thank you for giving us this opportunity to.
Yeah. So Nikhil.
Yeah, just to adding what Priyanka was mentioning. So these platforms, even for example, the kind of questionnaire that you created, that gave us a sense as to what these proposals were entailing to the market participants, that we may not be able to reach directly, or the such candid opinions we may not have received otherwise. So thanks for that also, and thanks for providing this opportunity. And we also have a lot of measures that we have carried out in last 2-3 years, and which we may not have been able to take it across all the participants that were present there. So in case if that also needs to be the market participants would like to understand that also, so we can have more sessions on that.
Okay. So Mita.
Thank you so much for having me. It was a fun and engaging conversation. And like Priyanka said, I hope this no longer remains the chapter we skip. It is an exciting chapter. And thanks again for having me.
Okay. Ankit, for this.
I think SEBI has been doing a wonderful job. I think large corporate is a step towards this direction, rationalizing the entire concept recently, and now this discussion paper. So I think it will definitely encourage larger retail participation. I myself look forward to invest in that in days to come.
Good. So last word from Pradeep, your side.
Yeah, so I would really like to thank Meeta and Ankit also for helping us in this thing, in this particular webinar. A lot of insights were also expressed by Meeta, which are very useful to us. I'd like to thank Nikhil and Priyanka from my team for a very lucid presentation. And but I would also like to add a point that SEBI is not an ivory tower regulator. Right. So we are a regulator who believes in being participative. We believe in being consultative. And that is something which you can see with an amount of consultation that we do. And our consultation is not just limited to the consultation period. We are available all the time. You can send mails to us. We try to solve things through circulars or anything for that matter. Our job is to ensure that the market remains vibrant, and this is something which can contribute to a very, very, very economically strong India. Right. So that is something which we want. So there we need to do a tightrope walk. As I said, we also need to ensure the market is safe, but also making it vibrant. So towards that extent, we have been taking a lot of reforms, and we want the public also to be participative. Like Nikhil and Priyanka also very rightly said, this platforms like this serve to be a barometer for what else, what can be a very participative thing, and we'll also come to know what exactly is the voice of the public. Okay, and I would really like to thank you, Pawan sir, and corporate professionals for this opportunity. And as again Nikhil said, those points which you had mentioned on the survey is actually serving as a barometer of what the larger India could also think tomorrow. So we are awaiting comments. So I also take this opportunity to exhort people to offer comments. We still have the lines open. It's still open till the end of this month. Please offer comments, and in case you have anything else to suggest on ease of doing business, please suggest so that we can take everything together in one shot.
Okay. So thank you very much. Thank all.
And I wish you all a very Merry Christmas and Happy New Year also. I think it's a very nice opportunity, a platform to wish everyone that.
Yes.
Same here. I think everyone from corporate professionals.
So now this is time to close. We have just crossed 7 minutes. So that is always we try to 4 to 6. This is our yardstick now. So friends, what Pradeep I will do, whatever we have received, discuss, and the poll and then point which I have given, compile it and give it to you in detail one on a suggestions basis. So when 29th is a date, so you can compile it and you can use it. And after, because this topic is only if you see the people were 100, but all they were interested, because this is a totally different crowd which I'm seeing this. So the best part is after when you will finalize, we will try to propagate and popularize this concept, and we'll have a program with investor community and SEBI, and we will organize this. So we can market that how investor can be used. This can be useful for them, and for corporate world also, that they can come and they can use this channel as a investment route. So thank you very much to all.
Thank you.
And because 29th is our next Wednesday, next Friday, but because you can understand in India also 31st is the date. So what we'll do, 29th we will not organize this webinar, and 5th we will organize New Year webinar with this thing. Happy New Year, Merry Christmas to all, and thank you very much.
Thank you.
Thank you. Thanks, everyone.
Thank you.